So recently I announced I was in the process of looking for another investment property, and I told you I was going to take you all with me. So today we're going to cover the next step in our Airbnb investing journey. Let's get into it. Hey everybody, my name's AJ, this is the Wealthy Idiot Show. I'd like to welcome you all back, but before we begin, smash the like button for the YouTube algorithm and subscribe to the channel so you don't miss any of this good stuff. Last time we talked, I broke down how I build the numbers out and calculate how we determine what properties are good buys for real estate investing, how all the math works, cash flow, return on investment, etc. So this helps us determine what type of property we're looking for. Like, in my experience, I have a specific type of house I know rents really well on Airbnb, and I want to try and get that type of house for as cheaply as possible, and then that's going to help me get the best return on my investment. So by doing all the numbers, we figured out what our sort of line is for how much we can pay for a property. And when we did this, we did it all around properties for about $400,000 in the Texas area based off of all the expenses that I've calculated. So we're going to start looking for properties around that price point. So now that we know that, the next step is to get pre-approved for a loan. So for the second part of this episode, I'm going to share with you my process and what that's looked like. But before we get into that, let's talk about interest rates. Just based off of the news, you may have seen that mortgage interest rates are on the rise and housing prices are starting to decline. We're seeing a nationwide decline of about 4% so far, and it's much higher in some areas like the Bay Area where I live. Sorry, Dave Ramsey, but like I said, the housing market is going to at least dip. I don't think it's going to crash, but it's going to at least dip. And his rant that housing prices will not go down, it turns out to be wrong.
I think you're making a mistake because you really do think house prices are going to go down, and I think you're wrong.
Because when you look at how much demand there is around the increasing interest rates, the data just does not support that people will continue to pay the prices that they were paying. But I don't entirely count that as a bad thing. So as a real estate investor, I want to get the lowest price I possibly can, but I also want the lowest interest rate. And it turns out one of the tricks to doing that is to wait for the interest rates to start as they go up, to start driving home prices down. And then as the home prices get down, we're going to buy a house that works mathematically. It still cash flows, we still have an ROI on it. And then we're going to rent that out. And when interest rates start to fall again, we'll refinance and lock in that lower rate along with the lower price of our house. The value of our house should start to increase, and we'll see all the gains as a result of that. So it's not entirely bad. It does mean that we have to be a little bit more careful because as houses values are declining, we're losing a little bit of our equity in the properties. We got to be smart about that. But it does mean that we have an advantage right now of producing a lot of wealth sometime in the future. We're just not entirely sure when, but we know it's probably going to be within the next 5, 10, 15 years. And since we're playing the 30-year game, we're not terribly concerned about that. So what are mortgage rates? So simply put, mortgage rates are just the price you pay to borrow money in order to buy a house. The rate just describes the annual interest you're going to pay on whatever money you haven't yet paid back to the bank. So for example, a 5% interest rate on a $100,000 loan will be $5,000 per year. And then as you start to pay that down, you'll be paying less and less interest on each payment because you're no longer borrowing $100,000 as you start to pay down the principal on that loan. And that's called mortgage amortization. We covered that before, but this is the basic simple understanding of what mortgage rates are. So where do mortgage rates come from? How do people make money off of this? The assumption would be that people make money off of loaning you money and then expecting you to pay back that money with a little bit of interest on top, but it's not as simple as that. So there's a number of factors that can affect your interest rate as you're looking for a home, and they're affecting mine right now as I'm trying to get pre-approved for a loan. The first and most important is probably your risk factor or your credit score. So basically that just tells the bank, is this person risky to lend money to, or are they pretty safe to lend money to? The safer you are, it's going to drop the rate as low as it probably can go for the environment as it's currently dictated. So you want a high credit score, and sorry Dave, that's another conflict we're going to have, but in order to get a high credit score, you have to be smart with debt. You have to buy things on credit cards and pay them off immediately. You got to buy properties and pay them down over time. You got to buy car loans and pay them off. That's how you get a good credit score. But with a good credit score and a very secure job, you're going to secure a pretty good interest rate on your loan. The next factor is the down payment. So the more money you put down, it takes a risk factor away from the bank. So if they're thinking you're going to put down 3.5%, That's why you have to get mortgage insurance, because the bank is taking a higher risk if you're putting a low down payment down. So if you go up above 20%, you can kind of drop the rates as the risk kind of declines for the bank. Your property type might determine your rate as well. So you even see, like, for personal properties and then for investment properties, the investment rate is like a whole percent higher. It's one of the reasons why we talked about this house hacking idea of buying a house and living in it and then moving out of it after a year and then renting that house out, because the rules state that all you have to do in order to secure that personal loan is stay in the property for a year. Once you move, it doesn't matter after that. So it's a good trick to get personal loans on properties with really low interest rates and make some money off of that. But like me, if you're gonna just go straight up investment property, your rates are gonna be a little bit higher because the bank looks at it as a little bit riskier. The length of the loan will determine your rate. So 15-year, 30-year loan. The longer it is, and the federal government is talking about 40-year loans right now, so the longer it is, the more expensive it's going to be. Then you have fixed rate and adjustable rate mortgages. Now this is a bit risky. This is how people got into trouble back in 2007, 2008 when the housing market crashed. They buy a bunch of adjustable rate mortgages where the interest rate is low now, but it's going to have a balloon payment, meaning it's going to go up at some point in the future, and it's going to go up pretty significantly. And if the Federal Reserve hasn't lowered interest rates, it's going to go up pretty far. And that's what ended up happening in 2008 as interest rates started going up and people balloon payments were starting to come due. They couldn't refinance to a lower rate, so they were trying to get out of their homes. But as people were trying to get out of their homes, the amount of supply that went out on the market increased. The amount of value in homes dropped significantly to below the equity for what they had on that mortgage, which means they were losing money, and tons of people filed for bankruptcies. So adjustable rate loans are a little bit risky. They start off with a lower payment and they go up. You have to know what you're doing if you're going to touch adjustable rate loans. I'm not going to touch them. Fixed rate loans are going to cost you a little bit more, but you're guaranteed that rate. So it helps us know, as long as we're cash flowing and our ROI looks good, we don't have to worry about it so much for the future because we'll be able to continue to pay that, and when interest rates drop, it doesn't really matter when for us. We'll be there to take advantage of that. And the last and probably most important impact on interest rates is economic factors. The Federal Reserve and our good friends at Freddie Mac and Fannie Mae. So the Federal Reserve sets the price for short-term lending, which does influence quite a bit of investment lending. So we talked before, a lot of people will leverage, meaning that they take out loans and they turn around and buy assets with those loans. And then as the assets grow, they'll cash out those assets, pay the loans back, and they'll continue this cycle. For a lot of banks and people at the top close to the Federal Reserve, they get the Federal Reserve rate, and the Federal Reserve themselves will loan them money in order to keep the economy afloat. And that is sort of how we determine how much money is available by the cost of it. So if it's a 0% interest rate by the Fed, then that means they're lending out everybody money for free, and all you have to do is pay back the principal. They're going to use that money for all kinds of stuff. Well, that's going to wrap itself around back to mortgages here in a second. But I want to talk about what banks do with your mortgages real quick, and that's going to explain why the interest rates from the Fed have an effect. So most of us would assume that when someone lends out money, the only way they get money back is from the interest of that loan, but it turns out that's not the case. What most banks will do is they will set up your mortgage, and then they'll turn around and sell your mortgage to somebody else. They'll try to collect a bunch of mortgages, and they categorize them in areas of risk. So they'll take a bunch of low-risk mortgages, and they'll call them risk type A. I think they use letters A, B, C. They'll take risk type A and they'll turn around and sell a giant bundle of those off to someone else, usually Freddie Mac or Fannie Mae. And so if you own a mortgage, you might see a letter in the mail. I just got one the other day that says, "Hey, we just bought your mortgage. You're now paying us." The bank is going to end up selling your mortgage for less than they would have if they'd have kept it for that 30-year time frame, but they're not looking at that as an investment game. They're looking at it as an income game. If I can get and sell all these mortgages to people and turn around and sell them, and I may make less money than the interest overall for that loan, but I'm going to make liquid real fast. And then I'm going to take that new liquid I just got and lend that out, and we're going to keep this process going. The limit on the amount of money I can make would only be determined by how fast I can keep turning mortgages over. Well, Freddie Mae and Fannie Mac aren't interested in mortgages that they can't turn around and convert into money themselves as well. So they operate in a similar way, just as a middleman for what's called a mortgage-backed security, an MBS. So they buy up a whole bunch of mortgages, then they create a security, kind of like a bond, out of them, and they sell them out on the stock market. People buy them up, and then you could buy a whole bunch of mortgages right now and be lending out to all kinds of people and not even really be a bank. If Fannie Mae and Freddie Mac can't turn those over quite as fast because it's easier or better to invest in other parts of the market, then it's going to increase the interest rate in order to increase the amount of money that they can get and sell these mortgages for. So they're going to say, look, we're having a hard time selling mortgages right now as mortgage-backed securities. So in order to do that, we're going to have to increase the interest rate on these bonds that we're giving to people. So if you're handing a bond over to someone and you're saying, look, dude, you buy this bond from me and I will pay you 1% every year for as long as you own that bond. Well, in a market where the inflation looks like it's like 9%, why would you want a 1% bond? So in order to inflate that a little bit, get those bond numbers up, they have to increase the interest rates on these loans so that they can get that margin to pay their investors. So then they get the cash by selling these mortgage-backed securities. They take that cash, they buy more mortgages, the bank takes that cash, they give more mortgages, and this is how the process goes in a giant cycle. Now, the way the Federal Reserve affects this is by, if they're restricting their short-term lending interest rates, people won't want to borrow money for a higher rate than what they could get when buying a bond. So if you're buying a mortgage-backed security that's returning 2% and you're borrowing money from the Federal Reserve that's 2%, you might as well just keep your cash. There's no point in that. So the bonds have to be returning higher than what it is you're borrowing that money for in order for it to make sense for you to do this leveraging method. Well, if that's the case, if a lot of people are doing this leveraging, then that means as the interest rates go up for the Federal Reserve, the demand for these mortgage-backed securities drops. So the Fannie Mae and Fannie Mac, they'll say, hey, look, we're not going to buy these loans from the banks unless the interest rates are higher. So they send out a sheet to the banks, usually about one or multiple times per day, that says, these are what the interest rates are, we're willing to buy from you. And then the banks are then going to adjust a little bit above that, to give themselves a little bit of a buffer. And then they're going to turn around and try to get as many mortgages as they can so they can sell it back to Freddie Mae and Fannie Mac. All right, so now that you understand how this whole process works and why we're seeing interest rates start to increase as the amount of people buying these mortgage-backed securities are starting to decrease because the amount of available money is starting to decrease because of the Federal Reserve lowering interest rates, that was a lot. But what does that mean for you and me? Well, in my case, I'm calling a whole bunch of lenders right now to get rates. And what I'm finding out is it's slightly higher than I thought it was going to be. Originally, I had said that I calculated up to about 6%, expecting that to kind of be the cap. But my best rate that I can pull off right now is 6.125%. So looks like it's a little bit above that cap. It might mean that looking at a $400,000 house might not be feasible. Might have to go beneath that at like 380. I don't have to work those numbers and try and figure that out. But as I'm working with these guys, I'm going to get pre-approved. I don't expect houses to be available in the price range I'm looking for just yet. I think that what's going to happen is we're going to go in and kind of lowball people. People aren't going to sell to us because we're offering way too little money. And then at some point, the housing market will have kind of slid down enough for it to make sense for us. And then we will be ready with a pre-approval to pounce and buy that home. In the meantime, we'll keep looking for rates, the best rates we could possibly get. And when we finally purchase this home, we'll be able to lock in a solid rate for a low-priced home that will be a great investment property for us for the future. And when that day comes, you'll have to stop on by again so that you could see what it is that we're moving on. But until next time, I hope that you enjoyed this episode. I hope you learned something about mortgage rates. I know that that's a lot of information, but hopefully it helps you understand why stuff works the way that it does. And maybe you got some ideas on how to position that information to make yourself a little bit of wealth. So please like and subscribe, tell your friends, and I appreciate you guys for stopping by. I'll see you guys next time.